From bad to worse, as bank runs spread through Shanghai banks. I'm your host, Steven Van Metre, and thanks for joining me today. In the story we covered a couple weeks ago, where depositors at rural Chinese banks were shut out and had their deposits frozen, well, I said that would start to turn into bank runs, and sure enough, depositors now in Shanghai are starting to pull cash. Let's pick this story back up where we headlined that there's a run on Chinese banks, and it's being ignored by the world. The songbook is eerily similar to the bank branches in a number of Chinese rural provinces right now, as multiple sources contacted by Asia markets have confirmed deposits at the following 6 banks have been frozen since mid-April, as we previously covered. And it's understood that the banks with branches across the Henan and Anhui provinces successively issued announcements in April stating they would suspend online banking and mobile banking services due to a systems upgrade. At the same time, clients reported their electronic deposits in online accounts, mobile apps, and third-party platforms could not be withdrawn. And this led depositors rushing to local branches only be told they were unable to withdraw their funds. And this was a story where we left it off before because there was no new information. We kind of talked about how banking regulators would likely step in. The problem perhaps would be resolved. And if it wasn't, it would lead to people starting to pull cash in what is considered a bank run. Well, let's continue the story now because the People's Bank of China has responded to the rural bank run. It issued a statement on April 25th saying the People's Bank of China is highly concerned, which is good. At present, relevant departments have launched an investigation. The People's Bank of China will cooperate with the relevant departments to protect the rights of financial customers, indicating they really haven't done anything and that those accounts, indeed, are still frozen. In regards to the cause, the developments raise serious questions about the health of China and its regulatory oversight. The more immediate concern, however, is the prospect of contagion, which we could see so far in the rural-only bank run spread to bigger cities. And there's evidence this is already happening. In one of the only mainstream international media articles reporting on the unfolding situation, local residents highlighted the seriousness of the situation and the likelihood of contagion. And blogger Jennifer Zhang has reported major issues with withdrawing cash from banks in Shanghai in recent days. The uncertainty, no doubt, exacerbated by the prospect of more lockdowns as COVID cases again spike. And all banks in Shanghai have restricted depositors from withdrawing money. A bank run is about to sweep China, she said. And I have confirmed and done a little more digging, and sure enough, that they're shutting down ATMs, suggesting to depositors that perhaps the COVID can be transmitted through dollars or through paper currency. Obviously not dollars. We'll refer to them as yen and renminbi. And so they don't want people using the ATMs, and they're limiting access into the banks, in some banks, to 6 people at a time with armed guards at the door as a mad dash for cash is hitting China's banks. And if people don't get their money, as I'm sure it would be for you and for myself, well, if people don't get their money, they're going to be pulling money out of all of their bank accounts real quick. And the situation, of course, in China is not like it's booming. There's big problems there, which would give depositors room for concern that their money may not be good. As these China developer bonds, something we've covered extensively, are flashing big warning signals. And some debt from firms including Shimano has slid below 25 cents as the crisis is now spread to builders that have been seen as safer. And risks are now spreading to even higher rated borrowers. As I mentioned, where there's one cockroach, there's usually more. A property firm long considered among the nation's most resilient, Greenland Holdings Corp, shocked investors last week with a proposed dollar bond payment delay. Earlier this month, China's 4th largest developer, Sunac China Holdings, became one of the biggest to default. And that suggested that most private Chinese developers face a risk of missed payment if they can't access fresh financing, according to some analysts. And refinancing global debt markets is out of the question for many firms after average yields on junk dollar notes jumped above 20%. On top of that, COVID lockdowns in Shanghai and elsewhere have added pressure on home sales amid a sector cash crunch sparked by a crackdown on excessive leverage. And this is, again, where the story goes, as we talked about, that where there's one problem, there's more, and where there's one bad developer, there's more. And now due to lockdowns, and you see a cash crunch, where when the financial system isn't moving and currency is not moving around the system, well, banks get caught in the middle. Depositors suddenly want their money as they see bad things coming. And of course, banks turn out they don't have it. Now, if you're concerned at all what a meltdown in the China's financial sector or real estate sector could mean to your portfolio and the global stock markets, well, you shouldn't be. I'll put a link up here to Portfolio Shield and the description below. Check it out when you get a chance, because Shanghai now, not Shanghai, but the PBOC is, well, telling the banks, time to get to work and get money out there as China raises pressure on banks to help struggling developers. Just what they need. Property development lending weakened despite regulatory calls as the trend intensifies in real estate downturn and hurts credit expansion. And I know what you're thinking. Why aren't they helping those poor people that have their deposits frozen? Why are they helping out the real estate firms? Well, that's a good question. Local branches of the People's Bank of China have called for meetings with banks in multiple cities last week to assess why loans have slowed, along with difficulties faced by banks and how regulators can help, according to people with knowledge of the matter. The move represents increasing concern from officials following repeated so-called window guidance for faster property lending in previous months, the people said, asking not to be identified. And what window dressing is, if you've heard that term before, it's referring to where a central bank essentially forces a quota upon the banking system of how many of the quantity in loans and size of loans it needs to originate to keep pumping money out in the economy. This is something Japan did and blew up spectacularly in their face. And here we see, rather than bail out consumers and depositors, China is looking to push the banks to lend to these insolvent housing and builders. Builders and regulators are counting on banks to provide a lifeline to the industry as bond funding and home sales dry up. Yet developers' cash flow from bank loans have plunged almost 30% in recent months, undermining President Xi Jinping's efforts to arrest a property slump that's worsening a slowdown in the world's second largest economy. As a number of developers have defaulted on or extended debt obligation amounts, banks are reluctant to increase their exposure to the sector, and you can't blame them, in response to regulators' demands. Some are only rolling over debt to prevent souring of loans, the people said. China's widening crackdown on corruption in the financial system has added to bankers' resistance. And whichever banks provide a lifeline to a developer will have to shoulder the risk. And why would a developer take on more debt without seeing better sales prospects? Without enough home buying demand, it's a dead end for either banks or developers. And this is exactly what happens when people lose confidence in the financial system. They lose confidence in their outlook to earn money and the economy. And of course, when your economy is being shut down by the government, it's really hard to do. And now you can see that the situation as far as those lockdowns may actually be back. As we heard, they were about to start easing, but maybe not so quick. As China's walking back virus loosening weeks after the reopening, as China's starting to reimpose COVID-19 restrictions just weeks after major easing in the key cities, raising concern the country may once again employ strict lockdowns to control its outbreak. Now, you think about that, you can't get your money now, and the country's going to lock down again? What would that tell you as a depositor? If you've got friends that have their accounts frozen, what are you going to do? And that's why we're starting to see this rush for cash in Shanghai, and perhaps that will then bleed out into other cities, and that's why customers want their money, because they're afraid it's going to get locked down, and they're not going to get it either. And China's youth unemployment crisis leaves tens of millions jobless. And of course, you look at their ability to create money, pay service debts, and this puts pressure on the banking system and causes, again, banks to lock down customer deposits. As fears are growing that joblessness will get worse in the country, surpassing even the peak in 2020 when the coronavirus first began spreading. The latest wave of the Omicron outbreaks and crippling lockdowns in places such as Shanghai have forced companies to cut headcount or reduce wages if they were fortunate enough to stay in business. And millions of people like Zheng, who were fired from internet companies, edutech firms, and property businesses, are still trying to find work, with a record 10.76 million university students expected to graduate in 2022 and hit the labor market. And again, it comes back to no confidence in the economy. Banks can't do anything here. People are going to want their cash, and next thing you know, the financial system comes toppling down. And a deputy chief economist for China at BNP Paribas says unlikely that unemployment has peaked yet, predicting it could reach as high as 6.5% in coming months. And that'd be a record since the government started compiling the figure in January 2016. The youth jobless rate could spike near 20% this summer when graduates hit the labor market. And of course, tack onto that a slowing global economy. as China factory activity gradually improves as lockdown eases, but still it's in a bad shape as the manufacturing PMI rises to 49.6, just contracting at a slower pace. And China's factories still struggled in May, but the slower pace of contraction suggested the worst of the current economic fallout may be coming to an end as the country starts to ease up on its lockdowns. The official manufacturing purchases index rose to 49.6 from 47.4 in April, and remember, below 50 indicates a contraction, showing that the manufacturing sector in China is contracting. And what do employers typically do when that happens? They lay off. And what China really needs is an expansion in their business where businesses are borrowing, pushing new money in the economy, and that makes the banks more solvent when your economy contracts and you've got high unemployment and people seeing that the other people's accounts are getting frozen. Well, you get a bank run, pulls the cash, and that topples again, as we talked about, the financial system. The non-manufacturing gauge, which measures activity in construction and services sector, increased to 47.8 from April's 41.9, above the consensus forecast, both months in contraction. And lockdowns have begun to ease, but actually starting perhaps to get reinstated, allowing some recovery in activity. And Beijing has tried to support growth through a variety of measures and recently wrote out broad support package that covered everything from consumption, investment to tax cuts and loan support. Premier Li has also repeatedly called for local governments to do more to stabilize growth, warning of dire consequences if they don't move decisively. But the effects of restrictions on production and supply chains will likely be felt for months as businesses struggle to restart. And even if China manages to right its supply chain and address other risks quickly, any sustained recovery is likely to be challenged by a lack of demand. And the threat of a cycle of COVID lockdowns, should there be more outbreaks, has weighed on business confidence, making them more cautious about expanding, especially at a time when the global economy is cooling. And consumers are also likely to save up rather than spend if they're uncertain about the future. And the recovery ultimately comes down to whether China locks down cities in the future, because damages on the economy could be deep, and there's some early indication that China is indeed going to reinstate some of those lockdowns, putting more pressure on its banking system, threatening bank runs, and threatening to topple their financial system, and due to the interlink of the global economy, could put pressure on banks throughout the world who have lent money to those China banks. I'm Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.